AI-driven tech volatility is colliding with resilient broader equities and a confused Federal Reserve signal, leaving stock valuations sensitive to any policy or credit surprise. You are watching vTalkInsight, Equity Pulse Daily for July 29, 2026. Let us unpack how a divided Fed, a restless bond market, and a rethink of AI spending are reshaping equity risk and leadership right now. The starting point for equities is still a soft landing backdrop, but with clear cracks in the consumer story. On the positive side, labor market indicators remain firm and continue to support aggregate spending, even as households report feeling under pressure. Behind the scenes, many consumers are stretching with credit cards and buy now pay later tools, and spending growth is slowing at the margin, especially once you adjust for higher gasoline and utility bills. Spending patterns are increasingly fragmented by income tier, so headline retail numbers hide a lot of dispersion. Value sensitivity is rising, and confidence data tell a weaker story than payrolls do, with fewer people describing jobs as plentiful and sentiment dropping in July despite cheaper fuel. Part of the recent boost to growth has also been one-off, coming from tourism and major events, which means the current pace of activity may be hard to sustain into coming quarters. On inflation, recent data have given the Fed breathing room. A marginally negative core consumer price print anchored medium-term inflation expectations, and modern money supply measures that point to a broadly neutral policy stance all argue against a new tightening push. The divergence between consumer price and personal consumption measures looks more like statistical noise than a renewed inflation surge, and falling crude prices further ease near-term pressure. Even so, the policy outlook is anything but clear. The rate-setting committee is split, with a real risk of multiple dissents, and estimates for a hike range from roughly 40% odds at this meeting to around two-thirds for September. Markets lean toward a hold, helped by the fact that real rates and overall financial conditions have already tightened meaningfully, but the lack of forward guidance from the chair keeps the reaction function opaque. For equities, that means the debate is less about one extra 25 basis point move and more about how long restrictive policy persists and how that interacts with earnings and valuation multiples. Turning to rates and credit, the long end of the curve has become a story of its own. 30-year yields have climbed as investors digest heavy sovereign and corporate issuance, waning foreign demand, and growing concern about fiscal trajectories and long-term inflation rather than day-to-day Fed moves. With real yields high and equities still trading on rich multiples, many relative valuation frameworks now flag long-duration bonds as attractive versus stocks, and flows into that part of the market are picking up. At the same time, fixed income volatility is elevated, driven in part by large data center and AI-related funding deals that have pushed yields wider and created choppier credit spreads. Credit default swaps across key tech names, including NVIDIA, have widened, and rates markets are pricing more risk than equity indices that continue to grind sideways with volatility in the high teens. Investors remain heavily allocated to equities, with limited hedging despite inexpensive options, high U.S. margin debt, and leveraged exchange-traded products in markets like Korea amplifying every move. Private credit adds another layer to this cross-asset tension. Managers such as Man Group are seeing record inflows, strong unrealized returns from opportunistic strategies, and very low default rates in direct lending compared with broader business development companies. Yet concerns are building around how some private loans are valued, especially where companies supply both earnings estimates and valuation multiples, and around insurance balance sheets that hold large pools of illiquid Level 3 assets at the same time as their sector credit spreads sit near historic tights. If regulators demand more capital, insurers may end up selling liquid holdings into a fragile market, which could be a catalyst for a broader repricing of credit risk that equities have not yet fully reflected. Energy and geopolitics remain a key swing factor for equity risk premia. Middle Eastern oil exports are estimated to be down more than 40%, and shipping routes through choke points like the Strait of Hormuz and the Red Sea face ongoing disruption from naval blockades and proxy attacks. Despite that, Brent and New York crude have retreated sharply from recent highs, helped by diplomatic channels through Oman and a pause in direct U.S. strikes, leaving prices well below earlier peaks even as global strategic reserves sit near their lowest levels since the early 1980s. For corporates, those risks are already visible in earnings. Hilton has reported almost a 30% drop in Middle East and Africa revenue. Royal Caribbean has warned that future bookings are starting to feel the strain from geopolitical tension, and LVMH has cited regional conflict as one reason for softer demand in its core fashion and leather division. On top of that, attacks on energy infrastructure and data facilities are heightening operational risk in the region, just as global data center build-out accelerates. Climate-related shocks are compounding the picture. France and Spain are experiencing their worst wildfires in decades, and because these events are not being treated as official natural disasters, insurers rather than governments are bearing most of the cost, which could pressure margins and capital ratios. In the U.S., surging power demand from data centers is straining grids, raising the prospect that facilities without secured generation could be disconnected during heat-driven peaks, an underappreciated operational risk for the AI infrastructure theme. The most dramatic equity moves continue to come from the AI and semiconductor complex. After an extraordinary run, chip stocks have fallen more than 20% from June highs, with Asia bearing the brunt as the Kospi dropped over 10% in a single session and triggered circuit breakers. Names like SK Hynix and Samsung have seen particularly sharp drawdowns, driven by a mix of profit-taking, concerns about the cycle, and rising competition from Chinese manufacturers across memory, equipment, and even core lithography, where new deep ultraviolet machines threaten ESML's dominance. Financing is a crucial part of this story. Around 80% of future funding needs across the chip ecosystem are expected to rely on external capital markets at the same time as hyperscalers have largely exhausted free cash flow on AI buildouts. Credit spreads and default swaps for major tech issuers, including NVIDIA, have widened as investors question leverage, the sustainability of AI chip pricing, and the risk of circular financing where vendors effectively fund their own customers to keep demand growing. Aggressive leveraged flows into semiconductor names in the U.S. and Korea are now unwinding, and technical indicators suggest the sector is not yet deeply oversold, leaving room for further volatility. At the broader AI platform level, the market is reassessing the Capex supercycle. Estimates for combined infrastructure spending by the so-called Magnificent Seven have climbed toward $800 billion this year, and investors are increasingly asking when this will translate into durable free cash flow rather than just revenue growth. Enterprise demand is evolving from simply maximizing AI usage toward extracting value and managing risk, which is supporting companies like Databricks as clients adopt multiple models, balance high-performance proprietary tools with lower-cost open-source options, and seek stronger governance and cost control. There are important offsets to the bearish narrative. AI and cloud Capex appear relatively insensitive to interest rates, since much of the spending is tied to strategic plans and funded from substantial existing cash flows. Major platforms such as Microsoft, Meta, Amazon, Oracle, and Alphabet now trade on forward price-to-earnings ratios below the broader index, offering some valuation support, and their core businesses remain highly cash-generative even if near-term free cash flow is depressed by investment. Meta's $14 billion data center partnership with BlackRock, where BlackRock funds about 80% while Meta retains operational control, shows how creative structures can scale infrastructure while limiting balance sheet strain. At the same time, leadership within big tech is fragmenting. Apple is notably cautious on massive AI infrastructure commitments, potentially positioning itself to benefit from excess capacity built by early movers, while insurers are excluding many AI-related risks from standard policies, effectively raising the cost of deploying advanced systems. Options markets are showing surprisingly muted implied moves ahead of major tech earnings, with little evidence of large-scale hedging, even as margin debt and concentration in AI names remain high. For the equity market, That combination of crowded positioning, rising credit stress, and skepticism about the return on AI Capex means that guidance from hyperscalers and chipmakers on spending plans, competition from China, and free cash flow trajectories could be more important for index direction than the next Fed statement, unless the Fed genuinely surprises. Outside the AI complex, equity internals look healthier than the headlines imply. The capitalization-weighted S&P has slipped only modestly, while the equal-weight version has risen, highlighting rotation away from mega-cap tech into quality names with solid earnings and free cash flow. Consensus earnings estimates have climbed about 15% year-to-date, and volatility around 18 on major indices fits an environment where policy and geopolitics can jolt prices, but the underlying growth picture still supports a constructive year-end view. Europe is a clear bright spot in this rotation. Regional equities are outperforming, helped by strong bank and consumer staples results and a powerful recovery in mergers and acquisitions, where deal volumes are up sharply and transactions targeting listed companies are on track to exceed $1 trillion with healthy premiums. Barclays illustrates the nuance. It delivered its strongest second quarter equities trading revenue in 4 years, lifting profits around 30% and prompting guidance upgrades, yet the stock traded lower as the market focused on weaker U.S. consumer and fixed income performance, pulling down UK peers. By contrast, Man Group has been rewarded for record inflows and assets under management, while staples such as Unilever and Coca-Cola have rallied on better than expected volume growth, effective pricing, and upgraded outlooks. In the U.S., a similar preference for operational resilience and cash generation is visible. UPS has beaten expectations, raised guidance, and now runs nearly 70% of its volume through automated facilities that cut cost per package by more than a quarter, while Ford has lifted earnings and free cash flow targets on the back of strong truck and SUV mix and disciplined cost control. Boeing has surprised with positive free cash flow, rising defense revenues, and a clear path to certifying key 737 models, supporting the idea that commercial aerospace is shifting from recovery to a growth phase helped by higher defense spending and potential new orders from markets like China. Payments and asset management names such as Visa and Raymond James are also signaling robust underlying activity, even as Visa trims headcount and reallocates capital toward emerging digital payment technologies. In travel, JetBlue has reinstated guidance and outlined a path to $1 of earnings per share by 2028 after gaining new airport slots, while Royal Caribbean has traded lower despite strong current results as management highlights that rising geopolitical tension is beginning to weigh on future bookings. Stepping back, the equity picture today is defined by a tug-of-war between a still plausible soft landing, a bond and credit market that is increasingly vocal about risk, and an AI and semiconductor complex that has swung from unquestioned leadership to a source of instability. Policymakers look broadly inclined to pause, but a divided Fed, elevated long-end yields, and thin energy buffers mean that inflation or growth shocks could still force a repricing, especially with equities crowded and hedging light. At the same time, rotation toward quality cash flow names, resilient staples, European M&A stories, and select cyclicals in logistics, autos, and aerospace underpins the broader indices, even as AI-heavy winners correct. From here, the key signals to watch are Fed communications and long-term yields, credit spreads in large tech and insurance, any renewed spike in energy prices or shipping disruption, and, above all, the tone of guidance on Capex and free cash flow from hyperscalers and chipmakers. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.